Hi, everybody. This is Gary Dean with Sentiment Timing, and this is our free weekly video report for Wednesday, August 16th, 2017. So, hope you guys been managing your trades safely. Things are going pretty much exactly as planned right now, and we are going to be approaching some very volatile times coming up, and you really have to be prepared, and you really have to stay away from listening to the gurus that are on TV that are have their 10 and 15 year outlook, which is absolutely useless because the market could go up 50 60% and go down 50 60% during that time period, and it's really just useless information. If you want to make money in the market, you have to be anticipating the big moves and buying the dips when the low is coming in, and you repeat that over and over, and just not pay attention to what these guys are telling you, because some of the things that are coming out are just absolutely bizarre. One of the guys came out and said he doesn't think the market will ever go down because of what the central banks and stuff are doing. I mean, how does anybody even know what's going to happen 20, 30 years from now? But this guy's going to say that it's never going to go down, and just everything that's been going on with ignore the drops and buy the dips. That's all you've been hearing. And what happens is it's a herd mentality, and I'm showing you this because what happens is basically when you have a herd running, the ones that are in the middle and in the back, they have no idea that the trend have changed, and the ones that are leading are usually doing the exact opposite of what the middle and the back of the herd is doing. So these are your institutions, and I'm showing you this because it's the same as the sentiment cycles that go on. When this is in the euphoria, you have your leaders or your institutions. They're not buying the euphoria. Though those are the clowns that are on TV that are just trying to get some airtime and saying stuff until things change, and then they switched hats, and what they are, they're the end of the herd, just following what's going on. But at the euphoric stage, institutions are shorting. They're not buying up here. They're building their short position, and then when the market starts to drop and we start getting into the panic, they cover their short positions, and when we get into capitulation, they start buying again. And what happens to all the people at the back? Right now, they're in this area and they're selling everything as they're buying. So you have to be in with the beginning of the herd or the institutions, and you have to know what they're doing. And one of the main things that they do is they follow investor sentiment, because they're not going to be running with your retail people. They're going to be doing the exact opposite of what they're doing, because that's their easy money. And the big moves come in the beginning days of a trend reversal, and they want to make that money. And so you have to know where sentiment is at all times, because if you want to trade like the institutions and be on the right side of the market before these turns happen, when everybody's euphoric on the market, you're selling. When everybody is capitulating, you're buying. And you have all this easy money that may be made. And once you start seeing things get extreme bearish, you start covering your shorts, and you start buying the dips. When you see everybody buying the dips and euphoric, you start shorting rallies, and let things play out. But the good thing about it is that you have pivot dates or turn dates that we give, that gives you an idea of when things are going to be playing out. So here's an example of what I mean by the institution selling. So today, you had your CNBC guys saying, see, all you have to do is buy the dips, trust the system. Yeah, they're telling you that as the institutions are outright selling these rallies. And there's a reason why they're selling, because this time period that we're coming into and approaching, they're going to be a very weak period, and people are going to watch their accounts get slashed. And why is that going to be happening? Because they're listening to everybody that's on CNBC or whatever Fox, they're coming on saying you just have to buy the dips, as they're secretly selling everything. And if you don't know all this, you're going to get caught on the wrong side. And here's your perfect example as far as when you get this is retail, really. These guys are thinking the market's never going to go down, and once you start seeing a series of bullish sentiment like this, usually it's 1, 2, 3, and then we get a dip. one, two, three, dip. And that's, that's really the way that they do it. And that's why they, really pay for Woody's institutional newsletter, because they, this gets broken down even more. But this is ours is on a retail end of it. And this is really all you have to know, is that when everybody is bullish on this market, you do not want to be buying blindly, especially when we're running into a time period when he's saying that there's shades of a 1987 style crash that has similarities to it. And what we've been saying is that even though, yes, maybe there's a crash, maybe there's not, we have no idea. The market will let us know. There's similarities of it, but the thing is that it doesn't mean that we're switching into a bear market. The 1987 crash, if you remember, this is 3 weeks. It lost 37%. So if you knew that this was coming, stepped aside and just positioned yourself for the drop. And then when we were down here, started buying, we started the new bull trend from down here. But 37% of your portfolio getting lost in 3 weeks. If you're not on if you're not on the right side of that, you're not going to be buying the dip down here. And guess what? As it's rallying, you're going to be selling the rest of your longs because you just watch your portfolio get hit. And then from there, once we take out the highs, then everybody starts buying again. It's the same. This repeats over and over again, and it's been doing it for hundreds and hundreds of years. So that was the bigger, let's say the bigger aspect of what we're looking at and what Woody says with the turn dates and with what he sees playing out. But now in the daily time, I take the shorter say version of things, but I follow what he's saying. And on Monday, I had told people, when I was leaving for the Cape Cod, so I had left them on Thursday, that don't press the short side, just manage your open short positions, because basically, one of the shorts was pretty much right at the exact top. So when the market's down 30 or 40 points from there, you don't want to be pressing the short side, especially when there's technical divergences and we are at some support levels. So I just said, just manage your short positions, don't get aggressive down there. And then on Monday, we saw the huge gap up, and it wasn't unexpected. And it's a secondary top that we've been actually talking about, and it's going to fail at resistance in the coming days or hours. So my initial targets were 24.65, 24.68. I'm going to bring you to the S&P here. This is the Monday, so we closed at 24.37. We had a top at 24.69, so that was 1 point. Now let's go back to this. So now fast forward to today, and I had said that I mentioned patience on Monday. Now that patience is paying off, we're at higher levels, and you can get better fills. Targets 24.70, 24.75, and 24.80. Those are where I said I'm going to be looking to layer in short positions. So let's go back. We had 24.70 right near the open. 24.75 was the exact top, and I waited, and if they head up tomorrow, then I'm going to be looking to short at the 24.80. But this is what, you have the overall picture that what's going to be playing out from what he's talking about on his turn dates. And then we also have the sentiment that's supporting what's going to be going on. And now you have on a short-term basis where to get in and out of these moves to make the most out of your money. So it's, things are going exactly as planned. And when I said that we hit just about the top tick here, this was that fractal pattern that I was talking about. And from this level here to this high here, it was exactly 7 points. From this high here to this high here, exactly 7 points. So I had mentioned that once we hit that and started going down, that I said this may be the actual top from the fractal pattern. And from there, we saw the S&P drop, almost 60 points. So this is, the action that we're seeing. So we don't really have any bearish divergences yet. We're off the oversold levels. So now we're at, a time that they can pull the rug out at any minute, or would he put some dates in for the coming times that if it doesn't turn right away. But we're prepared for this. And if you're not, and you don't know what's going to be playing out, you're going to be really, really surprised. And if you're just a bull, then you know what? you don't be buying right here. You wait for the low date to come, and then you buy the dips and you buy stocks that are 20% lower than where they are right now. That's all. If you're doing both long and short, you start positioning yourself on the short side on these turns, and then switch to the long side at the lows. But this pattern is bearish. We have bearish time periods. We have extreme bullish sentiment. So this is not an area that you want to listen to. These people that are coming on these financial news stations and saying just forget everything, buy the dip, the system's going to work, because they'll change their tune when they see the S&P trading below 2,200 or below 2,000 in a very fast manner. They're not going to be saying just buy the dips anymore. But if you're positioned correctly, like I've said, it's going to be one of the best times that you can, that you're going to have. So right now, things are in place right now. On the 15-minute chart, bearish divergences. So we may get some of a pullback. I think they may come up and test it again, but it's not guaranteed. And the way I'm looking at it, if they do, great, I'm going to look to short it. If they head down, I already have a decent position from all the way up here that I took some of it off down in these levels, and now I started layering back in again. So if they don't go up and head down, won't be surprising. I won't be caught off guard. I'm positioned for it. If they decide to come higher, then I'm going to be looking to short at the 2480. So like I said, some exciting times are coming. Be ready for it. If you want to know what one of the best market timers in the world is thinking, take the special offer that we have out there. And with that, have a great night, and I'll talk to you guys next week.